Hello, hello, hello. Welcome now, Stock Trades. Well, I hope you guys are doing great. It's been a while since we've talked, and lots has been going on in the market and definitely in my life. And currently doing an OBGYN rotation. But yeah, definitely chat down below if you guys want to know how it's going. So in this video, we're going to go ahead and talk about 3 different stages that we really haven't discussed in this channel that will definitely add value in your investment financial journey. So what I'm going to do here is I'm going to go ahead and just zoom in a little bit here on our stock terminal, so then you guys can see it a little bit more clearly and effectively. We're currently doing some changes in our studio here, so we're gonna go ahead and get back the camera on once we complete that. So that's the reason why the camera's off. Pardon me. Following this, we're gonna go ahead and talk about the financials for Clover. Just a very quick breakdown regarding the matter and what I'm looking for exactly. So overall, this is what Wall Street is currently looking at. So the first thing is we have a bear market, an earnings recession, and an economic recession. So the question is what to expect from 2023 Q1. So we're going to talk about that. All right. So that's a good question. So for the bear market here, we already kind of had this, right? Remember when 2022 was definitely very hard year for stocks. We had essentially, I believe, greater than 20% decline. So this is the first step where stocks start falling and investors become pessimistic about the future of the economy. It's often characterized by a decline of 20% or more. And usually things oscillate between, sometimes we get bear markets every 2 years on average, 2 to 3 years. And then the recessions come in around every 10 to 15 years. Then if it's a really big, if it's going to get to a recession level, we usually see step 2, which is an earnings recession. And this is what we are going to be seeing in the next couple of weeks. We're going to get a lot of earnings reports coming in, and we're going to start seeing, I believe, stage 2, right? Or step 2. So this is the second step. It is an earnings recession, which happens when corporate earnings start declining for at least 2 quarters in a row. This is a sign that companies are struggling to maintain their profits, and it's often leads to layoffs and reduced investments. Now, you might basically say, hey, Al, didn't Google, Alphabet, and a couple of other companies, Meta, start laying off folks? Well, yeah, this was part of the tech recession that we basically felt. And this was kind of the 2022 drop, right? And in fact, one might argue a lot of tech companies actually dropped in November of 2021, especially fintech and definitely folks regarding, Clover Health, right? Definitely dropped in November of 2021. If you log into the Mastering Stock Market course, you would see a couple of graphs, and you could go ahead and look at those predetermined graphs to look at using technical analysis on what would have been a great time to exit, right? But overall, the third step here is an economic recession. And this is the final step, and this is where the broader economy starts contracting. Essentially, everyone is struggling. No entity, nobody's making money here, right? We're talking about the whole market's down here, okay? So this is often characterized by a decline in GDP. This is a big one. Rising unemployment rate. Why am I repeating this? Well, if you're following the economy, ladies and gentlemen, we're at the most lowest unemployment rate we've ever seen, okay? So this is the thing that we're looking at right now, and Wall Street's just waiting on this to crack. Sadly, this is very sad because, these are people, right? Each number is a person, a family. So, but this is essentially how it works in the economy and capitalistic nature that we live in, all right? And then what essentially that then will lead to is reduced consumer spending. This is the most severest stage of this 3-step series. And it literally goes into contraction for at least several quarters, if not even years. Now, the beautiful part about this is usually the stock market is prognostic for future outcomes. Now, what does that mean? Well, it basically predicts what it might, what might the future hold. And sometimes it overpredicts, sometimes it underpredicts, sometimes it mispredicts, and sometimes it recorrects a recorrection. So it's definitely interesting, right? And this is where we have to use fundamentals. One of our members posted about Howard Marks, a great person who created a book called Market Cycles. I believe it's in our list. If not, we'll definitely add it. This is essentially what a market cycle beholds. So overall, this is exactly what we're looking at. And if you log into the Mastering Stock Market course, you're going to see all of these criterias in there. Okay. And this is what we're looking at. Now, a lot of folks, like in any bear market, they're always going to latch onto a reason why they're not buying. And they're going to say, I'm going to wait. It's going to crash. I'm going to go ahead and wait. And then all of a sudden, when it's too far up, then it's like, oh man, I'm already late. It's too, it's definitely terrible. And then all of a sudden, stocks start rising up another 10, 20%. And then they get to a point where they're like, okay, you know what? Screw this. I'm just going to go in and I'm going to just go in all in. And then unfortunately, that's when the stock market hits its peak. And then you have a new naive of investors that go ahead and slowly sell in at the bottom as stocks recalibrate and crash back down. So just very quickly, if you go into the SPX here, which is the S&P 500. And if you go to year to date, the S&P 500 is up 8.2%. Okay. We are pretty much, if you go in, the highest we've seen is 4,700. We are slowly making a recovery, right? But if you go ahead and look at the S&P 500 and break down those stocks, only a handful among them are actually up. Now, if you go ahead and look at Tesla, Tesla's up 71% year to date. So, I want to be very clear, because if we're hitting an earnings recession, then how do you expect stocks that have been up 71% year to date to stay like that? They're not going to trade sideways, I can tell you that. And if they are, then I would love to be wrong, because then people can continue keeping their money. But overall, back to the question, what do you expect from 2023 Q1? Well, I expect there to be some form of an earnings recession. Just look at Clover in terms of its recalibration of its revenues, right? And that's because of a different thing. But if you go in right now and you type in earnings recession, this is what you would find. Earnings recession to dominate headlines as Q1 reporting seasons kick off. Bank earnings to give further insight to recession questions. Follow your bank earnings because they're important. And earnings decline precedes recession, but profits haven't eased yet. Okay, so overall, this is what we're going to basically be seeing. And what I'm trying to do is I'm trying to essentially tell you and share with you what to expect from this, right? I'm trying to explain to you kind of the three stages here, because unfortunately these reports just tell you what's already happened, right? But they don't essentially basically give you what to do with that, right? So here's another Bloomberg article. I'll just scroll down to it because you have to pay through this. So I'll just scroll down so you guys can see it all here. All right. You can pause the video at any time. So now that we went ahead and did this, what am I looking at? Well, obviously, Clover here is at 80 something cents. And let's transition on to the financials here. Okay. So this is 2019, 2020, 2021, 2022. Well, if you go ahead and look at operating income, it was over literally $500 million, and it dropped down to 370 million. So they're obviously decreasing their negativity. So they're burning less cash. You can also see that in the net income. They had around $587 million of burn cash. Now they have $338 million. And this is coming from a $3.4 billion of revenue. So I expect them to get around, I want to say $1.9, $2 billion. So let's just make it simple, $2 billion, give or take. And it's going to be 4 quarters. Let's go ahead and divide it out. On average, they should have around $500 million a quarter. Okay. Give or take. Personally, I would love them to have decreased the revenue a little bit more so they can focus on profitability, but we'll see exactly what their free cash flow is going to be. I don't expect them to be profitable in 2023. If they can basically change that for me, then great. But if you follow my videos since 2021, I said that profitability ain't going to happen until, post 2024 to like 2026, between those areas. Okay. But if they can do it, then great. Okay. Earnings per share is becoming less negative. And now if you go ahead and look at, we got some, a little bit of dilution there from the former years. And if you go ahead and take a look at operating cash flow, again, less negative, and then free cash flow, less negative, right? And then, mathematically, you just take out capital expenditures, which you can see has decreased. If you go ahead and put the money sign here, you can see, my apologies, capital expenditures has increased, meaning that they're spending more money, but what they're doing is they're burning less cash. So which is great. Now, what am I looking at? Well, I'm looking at the free cash flow. I want to know how much cash are they burning. This is what I'm going to be looking at for the next quarter. And that's going to be a telltale sign of how this company is going to be performing. Once Clover Health gets to a position where it's essentially sustainable, where the free cash flow is sustaining the business as it basically projects, then they could dilute the further need of capital raising, which means that their book value is going to increase. Again, currently right now, and again, you have access to this to the stock terminal. All you have to do is say /master, and then it'll ask you for the ticker symbol, and then you essentially put any ticker symbol you want, and then it'll give you the file, and then you can go ahead and download it and do whatever you want with it. But overall here, ladies and gentlemen, you can see book value is at 73 cents. Currently, Clover is trading at 83 cents. So whatever percent premium over its book value. Now, as book value starts to increase, expect the stock price to start to increase as well. Why is book value increasing? Well, let's go ahead and take a look at book value equation. And let's just pull up anything on Google here. And let me see. I always like to. That's a good one here. Yeah. So, yeah. Book value per share is equal to shareholders' equity, preferred equity, divided by the total outstanding common shares. Okay. So, what is shareholders' equity? What is shareholders' equity? So, let's go ahead and explain what is that. You just kind of keep doing that. Okay. It's total assets subtracted from total liabilities. Well, what is an asset? Right? This goes back to essentially, accounting 101. What is a liability? Right? Some people think that a car is an asset. No, it's not. Right? Now, if you're renting the car and it gives you some form of revenue, then that's different. But normally, it's not. Right? That's money that's being owed. Right? So, current assets, well, if they're burning cash, ladies and gentlemen, their current assets are going down. Their asset value goes down. And if the assets go down, the shareholders' equity go down. And if the shareholders' equity go down, then what happens to the book value? Well, going back to algebra, since essentially shareholders' value is in the numerator, and if that larger number goes down because the assets go down, then the book value per share goes down, which is exactly what's happening right now because they're burning cash, right? So overall, if you recall, a lot of people that just started trading this company back in November when they started basically doing a capital raise, they were very upset. They were cursing out the board. Well, right now, imagine having to basically raise capital now. That was the right move. And overall, out of all the noise, the way I'm looking at it is I'm distilling it down to its simplest analog, okay? This company needs to reach profitability as fast as possible. Once it goes ahead and does that, and it weathers the storm, and it weathers these 3 stages of hell, then we can get to a position of when we get that reset, keyword reset, that is when the Federal Reserve drops interest rates down on zero, turns on the money printers, and then the cycle restarts again, where stocks essentially go past their intrinsic value. Everyone is happy, but our members are going to be smarter than others that are not in our stock terminal, and they're going to know exactly when to hand off those companies and stocks to the overly optimistic, right? Because right now we're buying it from the overly pessimistic, and those folks will turn into overly optimistics, and we will gladly sell them overvalued companies, because that's how Wall Street works, and that's how you make money. Ladies and gentlemen, I'll see you on the next one. Hopefully that was helpful. We'll go ahead on our weekly routine later on, but I just wanted to go ahead and kind of give you a 30,000-foot view, and I hope that helps. There's a lot to talk about, but this is a good, simple, kind of key point mind to focus on, okay? All right, folks. Have a wonderful Saturday.